Good morning, ladies and gentlemen. Welcome to Voltas Limited Q4 FY22 earnings conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal the operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Aniruddha Joshi from ICICI Securities. Thank you, and over to you, sir.
Yeah, thanks, Lizanne. On behalf of ICICI Securities, we welcome you all to Q4 FY22 results conference call of Voltas Limited. We have with us Mr. Jitendra Verma, EVP and Chief Financial Officer, Mr. Manish Desai, Head of Corporate Finance, and Mr. Vaibhav Vora, Manager, Corporate Finance. Now, I hand over the call to the management for their initial remarks and presentation on Q4 FY22 performance, and then we will open the floor for question and answer. Thanks, and over to you, sir.
Thank you, Aniruddha. A warm welcome to everyone. Good morning. For Voltas, the start of quarter 4 was...
Sorry to interrupt, sir. You're sounding a little soft. Can you speak a bit louder?
Hi there. Is that better?
Much better, sir. Thank you.
Right. A very good morning to everyone. For Voltas, the start of quarter 4 was anticipated to give glimmers of prosperity and growth. However, the beginning of new year came up with its own challenges. As India and the world were accelerating vaccination drive to overcome the pandemic, another variant came up as a surprise, dithering the efforts with the apprehension of more severity than earlier variants and caused impact on the economy and health. The extended vaccination had reduced the impact of this third wave considerably, both on the health and economy across countries. As the economic activities were returning to normalization, the world economy received another jolt caused by geopolitical tensions between Russia and Ukraine, causing disturbance in economic activities. The invasion has a spiral impact on the commodity prices. Global economic prospects have worsened amidst disruption in supply chain and due to imposition of various sanctions on Russia. Global economy now is on the edge of uncertainties arising from the ongoing geopolitical conflicts reflected in global commodity prices, including crude prices, differential pace of monetary policy normalization amid persistence of inflation at higher levels globally, supply disruption emanating from China's zero COVID policy and resultant restrictions on activities will be weighing on prices and growth of this economy. For India, all these factors have caused a speedy economic recovery and caused worry, given the elevated trade deficit. The balance of payments is also expected to shift given the global monetary policies, especially that of the US Fed. IMF, under the said unsettling issues, has revised its growth forecast downwards from 4.4% to 3.6% for the world and from 9% to 8.2% for India. In the early months of COVID wave, extended winter and increased input costs have impacted financial results during this quarter. Our unitary cooling products segment reported a revenue of rupees 1,818 crores, while project business reported a revenue of rupees 692 crores, and the engineering product segment reported a turnover of rupees 124 crores. Our consolidated total income for quarter 4 FY22 was rupees 2,704 crores as against rupees 2,683 crores in quarter 4 last year. Profit before tax was rupees 247 crores as compared to rupees 321 crores in the corresponding quarter last year. Profit after tax was rupees 183 crores versus rupees 239 crores in the previous year. Earnings per share not annualized for the quarter ended 31st March 2022 was at rupees 5.52 against rupees 7.18 reported last year. For the year ended 31st March 2022, the consolidated total income was higher by 5% at rupees 8,124 crores as compared to rupees 7,745 crores. Profit before tax was at rupees 697 crores.
Sorry to interrupt, sir. This is the operator.
Yes.
Sir, there's a lot of background sound from your line.
Okay, we will be careful. I think there is no sound. I mean, unless the line is bad. But let's take another few lines.
Sir, right now it's much better.
Right.
Thank you.
Profit before tax was at rupees 697 crores as compared to rupees 709 crores in the corresponding period last year. Profit after tax was reported at rupees 506 crores as compared to rupees 529 crores in the corresponding period last year. EPS for the financial year ended 31st March 2022 was rupees 15.23 as compared to rupees 15.87 last year. The corporate balance sheet continues to remain healthy with minimal borrowing for our overseas operations. While operational cash flow during the initial part of the year had been relatively weak due to loss of cooling product sales given the COVID-induced lockdown, however, revival of economy thereafter and pent-up demand for the cooling product towards the end of the quarter helped generate surplus cash on our balance sheet. As at the year end, cash and cash equivalents in our books stood at rupees 2,835 crores as against rupees 2,465 crores in the previous year. You all must have seen our snapshot of our results, so I will not be delving more into those numbers. I'll go segment by segment. For our segment A, UCP segment, quarter 4 and quarter 1 of a financial year are considered to be the strongest quarter for the year because of the seasonality. However, the segment witnessed lockdowns and restrictions for operations since last 2 years. Despite the fact and the hopes that this year would be clear of COVID and the industry will be able to bank on full season, Omicron at the start of the year dampened the hopes amongst the trade. Extended winters in the initial months of the quarter and increased prices of cooling products has further impacted sentiments of the channel partners and thereby the primary sales. Under the shadows of dampened demand and high inflation owing to geopolitical conflict, a start of severe summers across length and breadth of the country brought cooling products in high demand. Riding on this demand, the quarter has seen improved value growth over the previous year, resulting into restricted degrowth for the quarter 4. Unitary cooling segment reported a revenue of rupees 1,818 crores as against rupees 1,655 crores, representing a 10% increase over the corresponding quarter of the previous year. However, divisional bottom line has been impacted amidst increasing input costs, disruptive pricing by the competition and resistance by the trade on price increase. These factors resulted for decline in segment EBIT by 26% from rupees 261 crores to rupees 192 crores. Nevertheless, our focus on product placement, trust amongst the channel partners, and the value proposition has helped us register overall volume growth for the full year. Our focus on the inverter subcategory with competitive pricing and larger number of SKUs continue to favor us. Inverter category witnessed a good traction with the customers and now contributes over 70% of all AC sold by us, compared to 70% for the similar period in the previous year. Voltas continued its leadership in RAC category, the room air conditioner category, with the year-to-date market share of 23.4% as of March 22. To enhance our reach and to provide a customer-first experience zone for Voltas and Voltas Beko products has been launched in Mumbai during this quarter. In addition to it, we have continued with our expansion in exclusive brand outlets, which has reached over 200 outlets, and we aim to expand further by additional 50 outlets during the year. These will provide an enriched experience to our consumers with a complete product range along with attractive and differentiated consumer offer. The commercial refrigeration vertical has delivered yet another year of growth and even surpassed volume of pre-COVID period. Growth in commercial refrigerator products has driven by expansion of mom and pop stores, change in food habits largely driven by beverages and ice cream products in tier 3 and 4 cities, and higher participation from OEM engaged in chocolate beverages and ice cream products. In the air cooler category, limited window of sale and washout of season in the early months of the year resulted in piling of inventories at the channel partner end. However, our heat wave during quarter 4 has picked up demand for this economically cooling product. At the presence in all subcategories of the air cooler, balanced SKUs with competitive consumer pricing and expansion of channel network has resulted in brand increasing its year-to-date January 22 market share to 12%. We are happy to report that our commercial air conditioning business has done well even in these uncertain times. Opening of commercial places and focus on retrofit jobs along with the retention of the customer with attractive after-sale offering has resulted in the overall value growth for the quarter and full year under review. Business took various cost reduction initiatives and value engineering processes to offset increased input costs and thereby mitigated risk, albeit partially on the margin. For our segment B, electromechanical projects and services, the segment revenue for the quarter reduced to rupees 692 crores as compared to the previous corresponding quarter of rupees 875 crores, primarily owing to a low carry-forward order book and reaching to the completion stage for major projects during the year. Segment results during the quarter showed a positive momentum. The EBIT percentage to revenue increased from 6.46% to 6.88%. The carry-forward order book of this segment stood at rupees 5,260 crores. Over rupees 2,000 crores of fresh orders were added across both domestic and international markets. The carry-forward order book for domestic projects at rupees 3,638 crores contained a bouquet of orders across water, HVAC, rural electrification, and urban infra activities. The international order book stood at rupees 1,722 crores. Better and timely execution of projects coupled with a healthy project mix has driven performance of project business during the quarter. The division has not been spared by the increased commodity prices. However, a sensible negotiation with the customer and suppliers has mitigated the impact to a certain extent. The focus on the work certification and collection has improved cash flow and thereby return on capital employed while comparing with previous year. Meanwhile, the increase in global oil prices, lifting of COVID-related restrictions and focus of the government on the infrastructure development should improve business sentiment and open up further opportunities in our operating markets. We will continue with our strategy of picking up healthy orders, which will help in delivering a consistent and sustainable performance with minimal risk. In segment C, engineering products and services, the segment revenue and results for the quarter were at rupees 124 crores and rupees 41 crores respectively. Both our Mozambique and Indian operations have contributed towards improved performance on the back of the revival of the crushing and screening equipment and renewal of the maintenance and repair contracts with customers. Growing yarn exports, high demand for capital machinery both in spinning and post-spinning, and a well-defined approach on improving after-sales business resulted in positive performance during the period. Price increase by principals and supply chain related disruptions continue to pose challenges. Overall, the textile sector is expected to perform better given the PLI announcement and various other initiatives directed towards growth for this sector. For Voltas Beko, in the short tenure of close to 3 years, the Voltas brand has crossed an important milestone of 1 million units in the year, and thereby becoming one of the first brands to reach this landmark. Cumulatively, the brand has sold 2 million units, wherein the first 1 million units took 2 years, and the next 1 million has been achieved in these 12 months. The product enhancement is based on consumer insights, delivering a quality product at an affordable price. With the objective of localization, manufacturing facility has been expanded to frost-free refrigerator and fully automatic top-loaded washing machine at Sanand factory during the year. The production at the factory has also crossed 1 million units with better productivity and higher quality. This initiative of in-house manufacturing has helped the brand to introduce more customer-centric products, overcome supply chain disruptions, optimizing working capital and other cost savings associated with it. The brand continues its journey towards better market share, and it bodes well for its target of reaching market share of 10% by the year 2025. The recently conducted brand track study shows the improved score in brand awareness among consumers and higher recommendation as compared to the few incumbent players in the industry. Lower penetration in the market, strength of the joint venture partners, and accelerated expansion of reach will favor the Voltas brand to achieve its twin objectives in a time-bound manner. As the outlook goes, our hot weather will certainly help the cooling products to have an exponential growth after 2 seasons of washout due to COVID. Amid this positive demand and increased input costs, fragmented market and disruptive pricing by the competition will of course have its impact on the margin. However, presence of large number of SKUs in the growing inverter category, focus on the weak market, improving weighted average distribution and sensible price management shall help the Voltas brand to perform better than industry and thereby gain the market share. In case of projects business, completion of most of the running projects and internal policy of margin recognition in the initial phase of the project will affect the financials in the near term. However, a completion of business transition, a higher allocation towards infrastructure spend in domestic market, and improved opportunities in the overseas market should help us in overall performance for the year as we move forward. In difficult times such as these, the resilience of our brand, the strength of our balance sheet, the competence of our time-tested systems, and the capability of our people provides a definite measure of confidence. We remain optimistic. Thanks. I will be ending my introduction at this stage and pass it on for further questions.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Bhumika from DAM Capital. Please go ahead.
Yeah, good morning, sir. So just wanted to understand that, after a long period of time, we're seeing some market share loss because as you mentioned in the press release and in your opening remarks, that we have a market share of 23.4% as on March 22 versus last year 25.6. So, what has driven this market share loss in the last 2 months? We understand that there has always been a competitive intensity in the market, but if you can just talk about that. And number two, if you can talk about the price hikes that we've taken in FY22 and any further price hike that we've taken in the month of April, May.
Thank you, Bhumika. I think you are right in assessing that there has been a drop of Voltas market share, and it's very evident. However, in this period, when we look at the months of January, February, March, the summer specifically comes in the market of South zone. And it is also a known fact that for Voltas, our major strengths are in the other zones, though we cover all the national market across the country. And in the southern market, when we look at the price disruption by the other players has contributed in this fall of the market share. And as we would move into the later part of the summer months, the expectations are quite positive that the market share would be maintained. On the price hikes, we have taken price hikes in the month of January in the beginning. However, there is a time lag between our, the input cost and also for other competitors to take those price hikes. We'll have to further analyze at what level of, inventory numbers they were sitting at when they entered quarter 4, which we will not be able to, answer at this moment. And depending on that, some of the players have not taken the price hikes, and that's where we are seeing the disruption to a certain extent. For us, we still continue to see the cost increases as we are all seeing on the commodity side, which increase our input costs. And if these costs continue to increase as we go into the month, we will have to go for cost push price increases. Other than that, we don't see any reason. And whenever there is a decline on the input costs, we would be even willing to go down on the to be reasonable and fair to our consumers. So we are being very cautious or rather judicious on that aspect of price increases.
Sir, if just a follow-up on this, what would have been the price hike we would have taken in Jan, which got implemented through the quarter or this quarter now? And with this price hike, and given that the other peers have not increased their prices to a similar level or maybe lower, what is the price gap that is there in the market today between Voltas and some of the other key competitors?
I'll let Manish answer that.
Yeah, Bhumika, to add that if I take the full financial year, probably the price hike is a range of 12 to 15%. You can say in terms of the effective utilization, the peer will be of close to 1 to 2 months gap before the increased price gets billed to the channel partner. Now, having said that, knowing the fragmented market, each player is trying to find out a place for this market to gain and to have the presence over there. And because of which it is extremely difficult to see which market, which players are playing on the price or on the other side. But our analysis says that what Mr. Verma rightly said a few minutes back, that south where we have find some kind of more disruptions, generally because of the early setting of summer over there. where we have lost some of the market share. And to overcome that, we have also done some corrective actions to ensure that we sustain and maintain our leadership in across all regions. So in terms of price gap between us and the competition, I would still say 2.5% could be the easy cakewalk if I look some of the selective markets. But to get all India average price and all, knowing the fragmented market and the players working on different strategies, it will be difficult to quantify upfront.
Great, sir. There are more questions. I'll come back in the queue. Thank you very much and wish you all the best.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference, we request you to limit your questions to 2 per participant only. If time permits, you can come back in the question queue for a follow-up question. The next question is from the line of Vishal Biraria from Max Life. Please go ahead.
So, could you elaborate a bit more as to what could be our exit market share in March of 22? And when you say you've taken corrective actions, so what are the corrective actions, and in how much time do you expect to recoup the market share? Thank you.
For our exit market share, we are somewhere close to 18.5%. But having the lead in the earlier periods of the year, the market share in YTD we reported 23.4. And these are the external data being done by the external agencies. And we normally follow that given the status and the one uniform agencies carrying out this kind of market share collection of the data. Now, having said that, on the cost actions, during the season time, we come out with various schemes and initiatives directed towards the consumer, the channel partners and the consumers. And more such actions requires where we are seeing price disruptions or where we are seeing the other way around where the demand is very high and the manufacturers, the market is running short of the products. So all in all, there are certain initiatives like aggressive consumer subvention scheme, taking advantage of the lower borrowing costs today, which is prevailing in the market. You have a subsidized installation scheme directed towards consumer, giving the off-shelf schemes to the channel partners. There are various initiatives. I would not like to elaborate more on this front, but there are various tactics and tools the brands are having today on the shop floor to play around to ensure that the confidence and the shelf life which we desire to have it along with the channel partner.
Okay. Has there been any change in competitive intensity when you moved to March to April and May, or does it continue to be as severe, as intense as it's in March?
I would say that if I take the summer period, which is Feb to June, knowing the demographics of India, we have early summer that starts in the south, extended to west, east, and north. So as we move forward, given our strong presence in the north region, we are hopeful that we will be able to overcome this market share, I would say, matrix, and would go back to our old market share kind of leadership what we used to have. We are still leader in terms of the exit market share. However, the gap has been reduced over the second player, which probably will catch it up once we complete or exit the season at the end of June, July.
Okay. And just one follow-up on the same point is that some of the peers have focused on mass market products, whereas we may be on the mass premium side. So is it that the downtrading in these few months have increased and that has contributed as well to the loss of market share for us?
I would say other way around, given the under-penetrated market, probably the larger and all categories or the all top 8 players are eyeing for a mass affordable kind of product. You have the premium category, and the premium generally categorized as a 5-star, and when you're looking for a higher tonnage, because otherwise you won't be able to differentiate as such the normal or the mass product vis-a-vis the premium one. Yes, our focus is also there on increasing our market share on a 2-ton 5-star category, which we are proud to inform you that we have done better over there in the last 3 or 4 months time frame and increased our sub-segment market share over there. More is needed to do that, and we'll be definitely focusing upon that to improve or to balance the market in terms of premium as well as the mass products, so that's based on the consumer needs.
These are helpful perspectives, sir. Thank you very much.
Thank you. We'll move on to the next question. That is on the line of Ankur Sharma from HDFC Standard Life Insurance. Please go ahead.
Yeah. Hi, good morning, sir. Thanks for your time. Just hopping back on the share loss, on the AC side. So as you highlighted, it's coming mostly in the southern part of the country. So is it just that you've seen more competition, disruptive pricing? Was that the only reason, and you clearly did not want to match those prices, or was it also some element of supply chain issues, some shipments from China, etc., also kind of hurting your share in the south?
Ankur, if I look, even though when we talk about south, the south comprises of four major cities, I would say, in terms of Tamil Nadu, Kerala, forget about states, my mistake. Tamil Nadu, Kerala, Karnataka, and Andhra Pradesh. We are relatively strong in Andhra Pradesh and Karnataka. Where we have seen more disruption is largely in Tamil Nadu and Kerala market, where we have seen this market being largely driven by the organized and the regional retailers, where the ask on the price is generally on a higher side. This is where our deep analysis showing that some actions which we have taken on this part, albeit in the later part of the year, later part of the quarter, but I am sure that the action is working on the ground. But this is the primary reason I can say. Otherwise, in case of East and West, we have sustained or we have actually improved our market share over the last comparative period. And in terms of North, we continued our leadership over there.
And just to add to that, Ankur, is that the supply chain from China didn't have any major impact in the sale of the product. We didn't feel any shortages or anything like that.
Okay, fair. So I just have a very basic question, because if demand is so strong, we are even talking of stockouts possibly over the next month or so. Why is it becoming so difficult to pass on price hikes? Typically when demand is so strong, and having looked at this industry for the last 14, 15 years, typically price hikes are relatively easy to pass, right?
When you look at the competition, by way of the product differentiation, and as you will understand, a 2-ton 5-star market or a 1.5-ton 3-star market, the product differentiation between one brand to the other brand is there, but not at a very significant difference. So in that sense, when there is a one player, let's say, another competitor who doesn't increase the prices following the Voltas price increases, at that stage for the consumer, there is a propensity for him to move to the other brands. We are trying to study this more in detail, and that's where we say that we are taking immediate actions on the ground to come out of this thing. It's mainly from the price disruption as it is being seen right now.
To add more to what Mr. Verma said, Ankur, if you have the fragmented markets and top 20 or top 10 players are eyeing to capture a market size in order to get the leverage on the volume, obviously you find that such kind of disruption will take place over there. Some of the brands, when we said we have increased market the price hike of 12 to 15%, when you see the other brands, probably they would have gone into a lower price hike. And seeing the product differentiation is not clearly visible on the shelf of the retailer, it then all depends upon the kind of price competitiveness which is playing around in the ground. So these are the obvious reasons which you are finding it over there. But having said that, we still continue with our policy and objective of balancing both margin as well as market share, because we keep saying that the market share you can't bank. But yes, the market share also will give you in terms of the scale to leverage some of the cost on which you can ride upon.
Okay, so the understanding is correct that this, as you said, you will take back the lost share by the end of the season, and the corrective action would be mostly by matching price cut of competition. Is that how we should look at it? Or via incentives, subvention schemes, etc. Is that the way out, or help me if I understood this wrong?
Ankur, there are various cards in your hand to play around depending upon how the market is reacting to it. Somewhere we play a price card, somewhere we play the SKU, a differentiation, somewhere we go for a more consumer-directed initiatives rather directly, putting price into the picture. So all these tools are available, and when you are peak in the season time, all these tools can be effectively used to capture whatever you have the objective to attain it.
Okay, got it. Great. All right. Great. Thank you so much. All the best. Yeah.
Thank you. The next question is from the line of Atul Tiwari from Citi. Please go ahead.
Yes, sir. Thanks a lot. Sir, just another follow-up question on this market share thing. So, can you comment who are the big disruptors in the market? I mean, in terms of whether they are domestic players or MNCs or the Chinese players?
We have seen generally the fight takes place between number 1 and number 2. Obviously, we have seen some of the loss of the market share to LG. And we all know Lloyd become more aggressive in this market. Probably we don't require to comment anything about the competition, but looking into the volume which they are eyeing to have capture because of the new factory setup and all, and we have seen the results, it's publicly out, which they have reported a higher loss. Only these two players we have lost the market share. Coupled with, if I go to the Samsung, to a certain extent they have a very strong corner in the south, where also help them to gain market share over Voltas. So these are the three key players I would say to whom we have lost the market share. As all Hitachi, Daikin and all remain in the same bandwidth where they were there a year before.
Okay, sir. Thanks. And sir, on Voltas Beko, would it be possible to share FY22 revenue, EBITDA, PAT, and the exit market share?
I would say that we can share the data, but knowing the confidentiality and all, we would not like to put it. Anyway, it will part of our annual accounts and reports as such. However, let me give you the indications. We are very close to a 4-digit number as far as the turnover is concerned for the Voltas. And in terms of the exit market share, we are inching towards, in case of refrigerator, we are somewhere at 3.5, and for washing machine, we surpassed 4.
Okay, sir. Great. Thanks a lot.
Thank you. The next question is from the line of Niket Shah from Motilal Oswal Mutual Fund. Please go ahead.
Yeah, thanks for the opportunity. So just two questions. One is that when you said the competition it is very, very high. So for example, if you are selling at 100, the competition is selling at what? Is it 5% cheaper? And is it at a price where you can't match it, otherwise the margins will really collapse? Is that the way you want to think about?
See, as I said, we are widely spread in terms of the market. You won't find the price disruption or the price difference across all brands in some of the markets which are largely mature or which are, I would say, behaving in a proper way. However, in some of the markets, we have seen the difference of almost. And as I said, when I say the difference, you won't be able to get the difference in the average price index, which has been measured in terms of the end consumers. But the specific deals would have been carried out with the channel partner in order to ensure to get the shelf over there in the counter. So I would say the average price difference will be close to 2.5 to 3%. However, in some of the markets, it may go as high on the 5% side, and in some of the markets, it may go low less than 1%.
Understood. And sir, just to reconfirm what you said earlier, you said that, is my understanding correct that we expect our market share to come back to original levels by the end of the first quarter, or you think it will take some more time?
See, when I say we always optimistic in our approach, and many times you find us conservative as well when we give any forward outlook statement. So in our case, we are working, as I said, we have taken some of the corrective actions. Some of the corrective actions we cannot do it, knowing the margin and the reasonable share you need to have it in your financials. However, looking into all the possibilities, we are comfortable, or we are looking forward to regain some of the market share which we lost in the last 2 months. How much and more, I would not like to quantify as such. We remain conservative and prefer to deliver more than what we give outlook to the stakeholders.
Got it. And sir, would it be possible to comment on margins? Because while on one side there is significant amount of raw material inflation, but on the other side, this year summers have been extremely strong. So if you're able to show a disproportionate growth, then some operating leverage should benefit at some sense. So how should one think about margins for the next year? That's all from my side. Thanks.
The chief is if still you are facing a gap between your increase in input cost and the price hike which you announced, which means that whatever comes as on a volume part, we'll try to mitigate those kind of gap or bridging those kind of gaps. So on terms of margin, we are of the view that industry will see some kind of stress on this product front, and it will be difficult to quantify today at what margin and all. But to go back to double digit of market for the industry and for people like us, probably it will take some time. I would not like to quantify the period as such, but as I said, the efforts will be first to tap upon it, but knowing the situation in which industries and inflation is moving, and having the period of June, July to go on the summer, probably we have to cautiously watch on this position.
Sure, sir. I'll come back with you. Thank you.
Thank you. The next question is from the line of Ranjit from Mahindra Manulife Mutual Fund. Please go ahead.
Yeah. Hi, sir. Good morning. Just wanted to check with you, was there any disruption in terms of supply chain? Because we have a lot of imports coming from China. So would you say that there were some issue because of that, or it's largely because of the pricing only we have lost the share?
Ranjit, as we had earlier mentioned, on the supply chain front, there were no major disruptions. We had planned for our supplies for the full season, and there is no disruption on that aspect, except for one or two small delays, like some SKUs where delay was seen because of Shanghai lockdown and this and that. But majority of the summer was planned much in advance, and we fairly did well.
And Ranjit, if you recollect, in terms of the import as well, only few components now are remain on an import source. Largely every other components have been localized. So on that front also, the mitigation steps which were taken by us helped us along. As I said, there is we have witnessed some kind of delay, but disruption to assign from the supply chain probably is absolutely no. However, let me put a cautious note on that. We have seen a good amount of growth both in March and April, and I would go with the words of the other industry players as well. If we are seeing in excess of 100% growth for till June and July, probably the industry will have a complete stock out season, because to have a continuous growth of 100%, it is like achieving something which has not been planned yet.
Okay. Sir, if I can ask one more, what is our strategy now? We have seen through this and all this price disruption. So if you can share, as Voltas, how are you going to react to this situation? If you can, whatever you can share. Thanks.
Ranjit, we are not seeing this price disruption for the first time. Some of the brands in the past also have disrupted the price, but it could not continue for a long. I'm sure each one of them are looking into the bottom line as well while furthering the business. So it will automatically get settled over a period of time. And obviously, being a leader in this category, the kind of, as I said, some of the tools which we have, some of the cards which are in our hand, will play it at appropriate time to ensure that we remain healthy and leaders both in margin as well as market share.
Okay, sure. Thanks.
Thank you. The next question is on the line of Ravi Swaminathan from Spark Capital. Please go ahead.
Sir, thanks for taking my question. Can you give the rough breakup of the UCP segment in terms of revenue between air conditioner and non-air conditioning products like air conditioning, air coolers, and other products?
So if you recollect, Ravi, in the year beginning, we have merged the commercial air conditioner to our UPBG business, given the aligning on the risk and reward kind of matrix. So that contributes around 17 to 18% on the UPBG, on the UCP segment. If I remove that, the balance in the cooling product segment, we do have close to 80% going towards the air conditioner. Commercial refrigerator will have around 15 to 70%, and the rest is, I would say, the air cooler. Air cooler being a low-cost item, although it won't contribute significantly to the turnover, but given the advantage on the I would say, on the pricing side and the cost side, it will have a better contribution in the margin.
Got it, sir.
The benefit also not being witnessed in the current year because of the pile of inventory at the channel partner end due to the washout of two.
Okay. And so with respect to margin for the UCP business, so you had given some kind of comment, so just wanted to reconfirm on that. If you are talking about a 10 to 11% margin, we will be able to maintain in FY23, or there might be some downside risk to it because of the raw material inflation?
Ravi, in the today's time, it is very difficult to I would say, the expect the increase in input cost. Although we have seen softening of the commodity price backed by the lower demand in some of the economies. However, we cannot still rule out the disruptions and the inflation which is prevailing in the respective home countries. So it will be difficult to say, to give any guidance. But as we say in the past, that we won't like to be a leader only in the market share, but continue our leadership in the margin as well. And that will be the driving factor for us as we move forward.
Got it, sir. And my last question is with respect to the joint venture with Highly for compressors. Can you talk about it a bit more? And also the capex plans that we are going to do this year and next year.
Yes. So if I look from the Highly perspective, although it announced during the silent period, so I could not elaborate more to the investor fraternity. I would say that the Highly compressor, the investment which has come, keeping in mind, I would say it's a strategic decision. The reason behind it is because we are not expecting to have the product without compressor being there. And compressor is a critical product we all know in the air conditioner product category. It has the importance in the refrigerator and the commercial product as well. So in and all, looking into the availability of the compressor as well as the criticalness in terms of having the sales sustainability in this critical component, the decision has been made to invest in backward integration to have the compressor through a joint venture. And the decision to go for joint venture is largely driven by the technical skill, and the joint venture partner is among the global leader in manufacturing the compressors. And we have done the partnership with them for an inverter make compressor. So we are not looking into fixed speed compressor, because market is expected to go decline as we progress in the next 1 or 2 years aspect. In terms of the overall capex for the plant, both the joint ventures partners put together will have investments around 250 to 500 crores as we taken in 2 phases, probably with the capacity of going close to 1 million units when we complete both the phases.
Got it, sir. And the overall capex that we may end up doing over the next 1 to 2 years, including this JV?
I would say that if I take a midterm task of 2 to 3 years, because we committed to the PLI as well, and we are in the process of expansion of manufacturing capacity for both RAC and the CR. Put together, we are not expecting to capex cycle go beyond 350 to 400 crores in the near term, if I take 2 to 3 years from now.
Got it, sir.
Thank you. We'll move on to the next question. That is in the line of Ashish Jain.
One second, I just stand corrected on the earlier question. Not 250, 300 crores, it will be 450 to 500 crores. Extremely sorry for this. 250 is the equity portion. Yeah.
Thank you.
So capex will be around 450 to 500 crores in the next 2 to 3 years. It will take care of our PLI applications, which we did for the backward integration for some of the components, compressor, which is a joint venture, and expansion of the manufacturing or production capacity for both RAC as well as the commercial refrigerator.
Thank you. The next question is from the line of Ashish Jain from Macquarie. Please go ahead.
Hi, sir. Good morning. So my first question is again, on market share. So while, you have the market share loss is largely in the south, historically, you have shared that south is like 20-22% of our total revenues. So is it fair to think that, the market share loss in south is like disproportionate in the range of 20-25% to drive a overall loss of 6-7 percentage points, or am I missing something here?
Chief, what happened is, if you the other part of the country got an extended winter. We all know we didn't require to switch on the air conditioner in the night till probably end of the February. And that point of time, even when we've seen the contribution of south, which has gone as high as 30-35%, primarily because other reasons were not having the need or the hot summer. So that increased contribution, which otherwise should have been standard 20-22%, you're right, which has gone as high as 30-35%. And that this spur probably has resulted some kind of disruption which we are seeing in terms of the overall market share among the players over there.
Right. Then secondly, in terms of window air conditioners, can you just share some data in terms of how much of the industry is window ACs and how much for us is still window ACs? I know it's a pretty small number, but can you just share?
No, I agree with you. Rightly pointed out by you, the share of the window has actually coming down year on year, and we touched to around 19%. I would say for the Voltas, 19 and 20%, probably we are aligned with the industry as well. So it has come down from once upon time to having 25%. In the last year, it dropped to close to 23, then 21, and we're now seeing a level of 19-20% for the window type air conditioner.
Okay, and you think the proportion for the industry is also similar at 19%?
Almost, because you can't be too much away from the market, right. Because obviously you can't be 2x to the market is X.
Right. Okay, got it. Thank you so much, Manish. Thanks.
Thank you. The next question is from the line of Sujit Jain from ASK Investment Managers Limited. Please go ahead.
Yeah, just to get this right, the price increase for RAC segment for the full year FY22 for Voltas would have been in the range of 12.5 to 13% overall, right?
Yeah, now to 15, 12 to 15. Yeah.
Right, and now that at least one player has spoken about having raised prices in April, at least few players should be on par with Voltas in terms of price increase taken for 15 months.
It is difficult to control the expectations of the move of the other competition. So it is difficult for us to estimate. Yes, I know which player you are talking about, which has openly said about price increase. But at the same time, we have to see, has it been rolled out effectively across all markets? Because the challenges what the leaders and the other players are facing will be faced by them as well. The other player, when you talk about the across markets increase of 2.5, or what are the price increase being announced. So, as I said in the earlier comment, and Mr. Verma also commented, the effective rollout of the price since you announced generally takes almost 30 days to 45 days if I want to go on a pan-India basis across the lead SKUs into the price being announced. So that if I do from the quarter end and all, you won't get even advantage of more than 50% of the price being announced at the beginning of the quarter. But that's a good start, and that's the strategy all players are adopting, including Voltas, when we announced price hike in the earlier period.
The 25.8% market share that you spoke about in last Concall, which is Q3 Concall, was for 9 months.
YTD, right, sir.
And this is basically GfK Nielsen data, which is secondary data, volume data, only MBOs, not EBOs, right?
Yes, MBOs, and you know very well how GfK extrapolates the data. But there's only, as I said, there's only one agency carrying out such kind of analysis, because generally I don't want to explain the methodology, because that methodology being adopted by them earlier as well and now. So we are not pinpointing out to the terms of the methodology being adopted by them, but generally when GfK captures the data, they extrapolate based upon the base data over there, and many times they are not able to collect the data from all retailers across countries. So we take all this data in a good spirit. The reason being is because the market share is not probably the one which we are looking from this kind of data. It gives a lot of other insights in terms of the strength and weakness of the other brands, including the weighted average distribution of each brand they are enjoying in a particular market. So when we take this database, we go in a much micro way in order to find out what are the corrective actions or the need-based action we require to do it in some of the markets which probably we have to change or we have to move in terms of the distribution node.
This is volume data, right?
These are the volume data, right?
Thank you.
Thank you. We'll move on to the next question. That is on the line of Keyur Harish Pandya from ICICI Prudential Life Insurance. Please go ahead.
Thank you. Hi team. Just want to know on the demand conditions, we are hearing that demand continues to be robust. Now, are we as a company and industry able to source material even at this stage seamlessly, or are there supply issues either at the Voltas end? Probably you mentioned that there is no issue, but or at the industrial which may help us gain market share. And just ancillary question is, are we able to source say final product or components locally versus say import for this kind of demand? Thank you. So basically, just want to understand with robust demand, how is the supply situation, whether at the channel end or at the brand end, for Voltas and for the industry. Thank you.
So let me answer first the channel one, gentlemen. We all know today there's a huge demand of the product in the shelf. So basically, the channel partners' inventory will be a hand-to-mouth kind of situation. Probably they are not carrying even more than 15 to 20 days inventory in their warehouses, but it's already because the continuous engines are coming and we are seeing good amount of growth over there. If I look from the Voltas side, obviously it goes well for the brand manufacturer as well. So our inventory level has also come down drastically. And if I compare with 31st March inventory level, the capital employed which you are saying in a statement, and if I take the future consumption in the trend, probably the inventory is sufficient for 45 to 60 days. Although the continuous inflow is still coming, because when we project something on the growth side, we plan it over a base year, and here the base year was 2019, because 2021 has still seen some kind of COVID-induced lockdown and reduced demand for that matter. So industry has projected a good amount of growth, and I go with the projections which all players have carried out. And I said in one of the questions, one of the observations, one of the answer is, if the demand continues to be more than 100% of the last year, I am sure that all industry players would result or will go into the stock out situation sooner or later. But till today, what we are seeing the market, we are adequately covered till June, July.
Okay.
I would say June because June where the primary ends actually.
Understood, sir. And sir, how the proportion of the import versus say domestic supply would have changed this year versus 2 years back or last year post these restrictions on import of ref gas field AC?
See, most of the components have been localized wherever we find the ecosystem in place. We all know that the compressor is still one of the components, and some of the PCBs of the high denominations are still getting sourced through import. However, as we move forward, we are expecting that high amount of localization will take place to start with motors and the PCBs, followed by the compressor. So in terms of the percentage, I would say that a compressor contributes around 16 to 20% of the BOM. And if I look from the PCBs, which would add further kind of 12 to 13% or 15%, still that components are largely being sourced through import. Although we have the local arrangement as well. So although their contribution is almost 35 to 40% in the overall BOM, at least 20%, 30% of the requirements are still getting procured locally where we have some kind of ecosystem available in India.
Okay, understood, sir. Sir, thanks a lot and all the best. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for the closing comments.
Yes, we thanks all the participants showing interest in Voltas. I'm sure that 1 hour will not be enough for all the participants, given the anxiety and given the, I would say, the outlook and all. We are open for any question answer sessions, and you can reach out to us, and we'll try to answer it at the earliest. Over to you, sir.
Thanks for all the questions. I think the timing of this question is very correct. And as we have said that we are taking the corrective actions in the market, we should be coming back with the market share and continue to be the market leader on the market share as well as on the margin itself, because as we have said that it is not possible for all the other players to disrupt the prices and continue to make losses for long periods. With that, I really appreciate your time and thanks for the day. Thank you.
Thank you. Ladies and gentlemen, on behalf of ICICI Securities, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.